This is the Value Investor Podcast with Tracy Reinick. All things value, all the time.
Welcome back, value investors. So it's time to talk about what's going on at Berkshire Hathaway. Nobody knows. We're all in the dark. But they recently did report third quarter earnings, and that cash hoard rose again. It ended the quarter at $325.2 billion, up from $276.9 billion. Most of it was due to continued selling in two of their big positions, Apple and Bank of America. And I wasn't really expecting this, to be honest. I thought he might continue to sell both, but not at the magnitude he has been doing so. And this is bringing up a lot of questions about why. Why is he selling Apple, the biggest position, and what he considers to be one of the four pillars of Berkshire Hathaway, and also why now on the Bank of America position, and why lighten up there, just as banks are in a good position and their business is improving quite a bit. So these are questions that are kind of out there. Again, none of us know, and we only can pick from little tidbits we've heard from, say, the annual meeting. And there really hasn't been any other opportunity to hear from Buffett since May. I can't recall off the top of my head, but I don't believe he's given any interviews or been seen out and about by the media since the May annual meeting. So it's been pretty many months, and he continues to sell without any explanations why, really. Now, in the May 2024 meeting, he did answer some questions because the Apple sales were already known and out there from what it was at that time. And he did seem to kind of indicate that there were tax reasons for him to unload it. But that never really made that much sense to me, because there's been tax reasons to unload it the entire time he's owned it. And he bought it in 2016. So that didn't make, again, much sense. And now he's continued to sell it. And so that doesn't make much sense either, because if you are concerned about the tax ramifications to having this big gain, you would also be concerned about the tax ramifications on some of his other holdings that also have, these significant stock gains. Now, they're not as big of positions in the portfolio. So most people, blow them off, basically. But I'm talking about, in particular, Visa and MasterCard, two huge winners for him that they bought in 2011 and have never sold any shares of since they bought them. So aren't there tax concerns with that too? Yes, there would be, but he's not as concerned with those. So he's sitting on this huge cash amount. But on the flip side, he has been using some of the cash over the last 6 years to buy back Berkshire shares. Now, he has always said he's only going to buy back Berkshire when it was attractive enough to buy. And on a book value ratio, he has always said he wouldn't buy higher than 1.2 times the book value. And these are of the A shares. And currently, the A shares are trading at 1.6 times the book value. So no one should be surprised, like, hey, he's stopped buying. But more interesting isn't why he stopped buying necessarily, but that he has been lowering the amount that he's been buying back in recent quarters, even before this one where he stopped completely. So this was the first quarter where he hasn't bought in 6 years. But last quarter, you'll remember, I think he only bought like $350 million worth, which again, with $276.9 billion in cash, was almost laughable. Like, why bother to do $350 million or whatever it was? It was around that amount. That didn't make any sense. So it does make sense now that he's just stopped completely, because it was just too laughable to buy that little amount. And if you think the value isn't in the shares, that they are too expensive, expensive, then you should not be buying anything, even if it's 350 million. So he has stopped that completely. But the underlying question still remains. Why? Why is all this happening? What is he going to do with the $325 billion that is invested in the treasuries? He's getting, 4 to 5%. So they're making quite a number of billions every quarter. It is going to compound onto this cash position, even if he sells nothing else and buys nothing else. It's going to sit there and grow. So what is the end game? And I know a lot of people on social media have been talking about how this amount of cash is not that unusual. Berkshire has owned a big percentage of the overall portfolio in cash in the past, specifically kind of at the end of the dot-com era. They couldn't find anything to invest in. The dot-com bubble was raging. Stocks were expensive. To buy a company outright was expensive. But, he just sat on the cash, and that cash position did rise. And then it was deployed in the early 2000s when the dot-com bust happened, stocks got cheaper, and then Buffett was sitting there on a lot of cash. Could buy things like PetroChina. He got real cheap and sold for big gains just, 4 or 5 years later. And we've talked about that purchase in the past too. So a lot of people are thinking, oh, this is what he's doing again. He's getting the big cash hoard and he's going to deploy it when things get cheaper because they're just, it's too expensive right now. And I might say, yes, that could be the case because he is still getting 4 to 5% for this cash. It's not nothing. And he is just going to grow it here relatively risk-free, right? But it doesn't, there is other differences from what happened, say, about almost 25 years ago now. And one of those is that Warren Buffett is now 94 years old. He's not even, in his late 60s or early 70s like he was during the dot-com boom and bust years. He's a lot older. His co-manager, Charlie Munger, recently passed away earlier last year. I guess it was about a year ago now. And so he's without his trusted co-manager there as well. So some of these things have changed, but I think someone who's 94 and thinking about how to manage this cash and the portfolio as well as the businesses might be thinking differently than someone who is 69 or 70 might be thinking. But we don't know. We don't really know what's going on behind the scenes. All we do know is that the cash is sitting there. And it does make me think maybe I should be buying this just for the cash. I am getting, 5% on it, and it's got to be deployed at some point. So what are the options for deploying it? Well, he could buy some more stocks, but we're all sitting here with stocks at all-time highs that even on an earnings basis, they're expensive, and he would have to buy, shares in some other mega cap company outside of Apple. He also owns a small position of Amazon, but it has to be something massive enough where he can deploy $100 billion or more into it to buy shares. And so that there's not many that fit the bill there, but he could do that, could buy more stocks. I've had the whole episode earlier this year about how I believed he should buy Alphabet, ticker GOOGL, because it was the most cheapest of the Mag 7s. It was very attractive when I talked about it on this podcast I think it was March or early April of 2024. It was trading with a PE of like 20. I think now, after this recent earnings report, it is more expensive on a PE basis, but it's generating the kind of cash flows he likes. And it has the management and some other things that he likes. He even somewhat understands the business because he bought newspapers back in the day for their advertising business. And now that is mostly what you buy Alphabet for, is the advertising side. And that's really crushing it, including on YouTube advertising. But I see the forward P is at 21 right now, still very attractive for what is happening with the growth on this company. PEG ratio is just 1.2. So that is very low. If that got under 1, it would be really, really interesting with this stock. Still expensive on price to book and price to sales ratios, as you might expect. Price to book is at 6.6, price to sales at 6.1. But as I've talked about, that price to sales ratio for a tech company being under 10 still makes it really attractive, because 10 is kind of the level where it's considered too pricey. I never expect to see Alphabet trading with the price to sales ratio under 1, unless there was, some kind of disaster going on at the company, because that would just be, hard to believe that we could get those sales at Alphabet, these quality sales, that cheaply, like basically on sale. But even if I could get it down to like 2 or 3 price to sales ratio of a 2 or a 3, that would be extremely cheap. So could buy back the stock buy a stock like Alphabet. He could add to a position like at Amazon, but it wasn't him who bought the Amazon position originally. That doesn't necessarily mean anything, because Apple originally wasn't either, I don't believe. I think one of the lieutenants bought a small position of it, talked to Buffett about why he did it and what he liked about the company. And then Buffett was like, this is fantastic, and went all in. And so it doesn't stop him, but Amazon has always been more expensive on just basically almost every metric that a value investor looks at. So I don't see him adding that one. But any of these are an option to buy more stocks. Now, he could also buy companies outright. He could buy quite a few, but he hasn't really done that much in even recent years with Berkshire's cash. And part of his reasoning at the annual meetings has been that he really can't find that much of value. The most recent company purchase would be maybe Pilot. That's the truck stop company that he bought, but he's bought it in phases, and he bought like a position in it, I believe, like many years ago. I want to say even like maybe even 2016, 2017, 2018, somewhere in there. But the last 2 years, he's bought even more of those companies, now owns Pilot outright. But he's only spent I think it was about $12 billion or so buying it outright. So you can see $12 billion, he's going to get that this quarter just on the interest alone that he's going to generate off of the treasuries in this cash hoard. So even buying something as big as Pilot isn't really going to do much to make a dent there. So I'm not sure they're going to go this way. I've seen people on Twitter talking a lot about how, he can buy these, 10 or 15 companies, and it lists them all out. Some of them are much bigger size companies, $50, $60 billion companies. But the thing is, he is, as I mentioned earlier, 94 years old. And if Berkshire Hathaway buys a company outright, that has to be absorbed into the bigger structure. That takes time, energy, everything, and it's going to take a couple of years before a company, especially a bigger one, is absorbed all the way into Berkshire Hathaway. And I'm not sure a 94-year-old CEO would want to undertake that right now, but he did manage to completely buy out Pilot in 23 and 2024. Even at the ages of 93 and 94. So that remains on the table as well. You can also do a combination of buying the stocks and buying some companies outright to get rid of some of the cash. But another thing he could do is a special dividend and just give it back to the shareholders. However, Buffett has spoken out about dividends in general, especially even a special. So I don't foresee them paying out to the shareholders until maybe a change in management, until he is no longer CEO and then someone else decides, hey, we are going to pay this out. So those are some of the options of what to do with the billions, but we won't know. And I'm just assuming it's going to grow to maybe around 350 billion by the end of the fourth quarter. These are incredible numbers. Just thinking about a company sitting on this level of cash. Even the tech companies never got anywhere close to this level of cash. And now they are spending it down. They've been spending it down with share buybacks, massive, like $70 billion share buyback plans and dividends. And now they're actually deploying it into CapEx on AI spending. So they're getting rid of it in many different ways. But Berkshire Hathaway doesn't really have those options. So it's still a mystery, and we're still waiting. But Berkshire Hathaway, like I mentioned, should you buy the B shares? It is a Zacks number 4. It did just report earnings. They weren't that good. The cash situation is overshadowing a lot of what's happening with its actual underlying businesses. BNSF, the railroad, was better than I was expecting. That wasn't bad, and that is one of the 4 pillar companies. Its energy businesses aren't that great right now because natural gas and oil are both, kind of depressed in pricing right now. So that was to be somewhat expected as well. But its retail businesses, including Pilot, they said were weak across the board. And they own quite a few number of retail businesses, as I call it. So that would be like Pilot with the truck stop businesses. But that also includes the furniture business. They own a jewelry, See's Candy, Dairy Queen. There's a bunch of others. Well, even you could put Benjamin Moore, the paint company, in there, even because they do have stores, don't they? I think they do. And that is very much like, people buying that product, and that goes to the consumer. So all of that was not good this quarter. So estimates cut on Berkshire, and that's why we're getting the Zacks number 4. And there's only a couple of analysts that cover it because it is such a big conglomerate. It's kind of its own universe, and the analysts don't want to just be stuck covering it and trying to figure it out, as I do on this show. So they don't want to write notes about, like, what is he doing with the 325 billion? Mysteries abound. But we do have revenue growth of just 1% for this year, revenue growth of just 1.7% for next year. That's not that great. PE of 22.7, PEG ratio of 3.2. None of this says cheap, like I was saying. And it's, not a cheap stock. So if it gets cheaper, I might be interested just for that cash hoard, really. And some of its other businesses, what if those are spun off in some way in the next couple of years? I might be interested in just owning Dairy Queen outright, or See's Candy, or Benjamin Moore. So these are all the things going on at Berkshire. What about those sales in Apple and Bank of America? Does it concern me? No, because we don't really know what his reasoning is. They were big positions. It's always good to be diverse in your portfolio. I'm okay with him lightening his position on Apple, especially given how expensive it is. It's not a cheap stock. Its growth is really slowed. There is a reason you might want to lighten up and take some of your profits off of it. Nothing wrong with taking profits. Same with Bank of America. He did have some profits there as well. We know the struggles of the banks. They are seemingly a little bit hotter again here as we're ending 2024. But Bank of America, still was a big position in his portfolio. And again, nothing wrong with lightening it up. I'm taking a look just real quick. Bank of America PE is at 12.8. But with banks, you really look at price to book. It's just still 1.18. And the bank analysts always say, buy at 1, sell at 2. So it still is very attractive here at this price to book ratio. And so that's not really an issue if you are a value investor looking at the banks. This is still pretty attractive. The banks have not, as I mentioned, busted out to new highs. But maybe someday we may get those. I've covered enough of them here on the Value Investor podcast, as you all know. And a couple times we had like false breakouts, like it's happening, and then it really has not. But currently, year to date, Bank of America is up 33.8% to new 2024 highs. The S&P 500 is up 25%, so it is now outperforming the S&P 500. Over the 1 year stack, it's up 61%. S&P 500 is up 35%. So it's had a real good bounce off of the 2023 banking crisis lows. And but 5-year returns, Bank of America up just 36% versus S&P 500 up 91%. The banks have really lagged, even with the dividend yield in there, which this does not include. The banks really underperforming. So maybe that's why he's getting out too. He's tired of underperforming. We're not yet back to the 5-year highs. 5-year highs were in 2022. And then the Fed started raising the rates. Bank shares tumbled. Then we got the banking crisis. They tumbled again. So trying to get back to those 2022 highs. Then maybe we get the breakout. But I've been saying that a long time, so we'll see. But if you are interested in any of these stocks that I mentioned today, so there is Berkshire Hathaway. You can buy those B shares. They are up this year as well, but we're hitting new highs earlier in the year and have pulled back a little bit, but again, still not cheap. So those are at BRK.B or -B, or sometimes just B. So B as in boy, R as in Robert, K, dot, B as in boy. That's how it is on Zacks with the dot. Then I talked about Alphabet. I own that in my own personal portfolio, but I think it's cheap here, and I would still be a buyer as a value investor. Ticker is GOOGL or GOOG. Then Apple, ticker AAPL. Bank of America, BAC, and I mentioned Visa and MasterCard. Visa is just V. V as in Victor, it's just one letter. And MasterCard is MA for MasterCard. Both are not cheap any longer. So it's hard to justify as a value investor buying one of those. But great companies. That's why Buffett continues to own it, and it hasn't sold out because they just have been, beasts, as I like to call them. Visa up 70. Nope. Let's see. Let's get the year to date. Visa up 18.3% year to date. MasterCard 23%, both underperforming the S&P 500, which again is up about 25% right now. So both of those underperforming Bank of America as well. That's surprising because they have been just pretty solid stocks. But I'm looking at the 5-year now, and both Visa and MasterCard underperforming the S&P 500 on the 5-year stack now. I would not have guessed that. Wow. Because they did have the sell-off in 2022 and then just haven't been powering higher. I mean, they're not NVIDIA, and the S&P 500 has NVIDIA in there. But to see that those two underperforming because they have been such big winners since they went IPO back in around 2008. So just looking back, I clicked on the all button here, and Visa now up 1,865%. Since its IPO. And then I have MasterCard. Can this be right? I don't know. It's up 11,478%. How could Visa only be up 1,800? Either way, you made out if you were in those. Bank of America, going all the way back, though, to 1972 for our data is up 1,244% in that time period. So, but you're owning it quite a long time period of going back to 1972. So That's all the stocks from this episode, but we're going to keep tuning in to Berkshire Hathaway as we go on because this is an ongoing, growing mystery. What is going on at Berkshire Hathaway and what will happen with that cash hoard and everything else at the company as we move forward? But we're probably not going to find anything out until the next earnings report, which won't be until 2025. So we're just going to have to keep watching and seeing what goes on. So you want to be sure to subscribe to get all of our podcasts so you don't miss the upcoming 2025 podcasts. Yes, I'm going to do my famous podcasts that look at what you should be buying for value into next year. It's been a great year for value. So is it going to be hard to find value stocks? I don't think so, but we are a little bit hotter now than we have been in the past. And I will be running the classic value screen like I always do in early 2025. So you don't want to miss that. You can get us on Apple, Spotify, we're on Amazon Music, and we're anywhere pretty much you can get podcasts, but be sure to get us. And I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.